everyone. Let us discuss on project cash flow estimation. In a capital project, the estimation of cash flow is very essential because this cash flow estimation will give you the exact result of a capital project, that is whether that project is beneficial for us or not. The three basic steps in determining whether the project is financially worthwhile or not is to estimate the project cash flows and establish the cost of capital and applying a suitable decision of appraisal criteria. The financial appraisal of a project deals with the cash flows. Cash which goes out of the firm is known as cash outflow. Typically, an investment is a project is an outflow. The cash that is received in future from the project is an inflow. We should remember that the result of an evaluation of the project are only as good as the accuracy of our estimation of cash flows. Okay, there are different principles for measuring the project cash flows. In developing the stream of financial cost and benefit, the following principle must be kept in mind. The first principle is separation principle. The second one, principle of financial cost exclusion. The principle of incremental cash flows. The principle of long-term funds. The principle of post-tax. And finally, consistency principle. Okay, let us elaborate the separation principle. This principle highlights that the project should be evaluated from two different angles. There are two sides of a project, that is the investment or the asset side and the financing side, and the cash flows associated with these sides should be separated. That means a project should be dealt from two different angles, that we should clearly separate the financing side and the investment side. Both sides include the cash flows. The financing side incorporate cost of capital and the investment side has its own rate of return. But we should remember that in calculating the projected cash flows, we never include the financial cost. That is, financing cost should be excluded. That is highlighted in the second principle, that is the principle of financing cost exclusion. When the cash flows relating to long term or being defined, financing cost of long-term funds should be excluded from the analysis. That is, by saying the financing cost of long-term funds means that interest on long-term debt and equity dividend, etc., all should be excluded. Operationally, the exclusion of financing cost principle means that the interest on long-term debt is ignored while computing the profit and taxes. The expected dividend are deemed to be irrelevant in cash flow analysis because the dividend pose no difficulty as they come only from the profit after tax. Interest needs to be handled properly. Since the interest is usually deducted in the process of arriving at profit after tax, an amount equal to interest, that is 1 minus tax rate, should be added back to the figure of profit after tax. This should be elaborated in the following equation, that is, when we calculate profit before interest and tax into 1 minus tax rate, we will multiply profit before tax plus interest into 1 minus tax rate. That finally will give you a result, that is profit after tax plus interest into 1 minus tax rate. Thus, whether the tax rate is applied directly to the profit before interest and tax figure, or whether the tax is adjusted interest, which is simply an interest into 1 minus tax rate that is added to profit after tax, we get the same result. Therefore, this principle highlights that we should exclude the financing cost, especially the cost of long-term funds, both long-term debt and equity dividend. Let us move on to the next principle, that this principle highlights the importance of the project, whether that project is adding any incremental cash flows, whether cash outflow or inflow to the firm. That is analyzed with the help of this principle. The cash flows of the project must be measured in incremental terms. To ascertain a project's incremental cash flow, one has to look at what happens to the cash flow of the firm with the project and without the project. That means this principle highlights whether that project is beneficial to the firm or not. The difference between the two reflect the incremental cash flows attributed to the project. Therefore, the incremental principle mainly highlight that the project cash flow for an year T is equal to cash flow for the firm with the project for the year T minus without the project for the year T. Therefore, in incremental cash flow, we will get the difference between the with cash flow and with cash flow of the project and without the project. In estimating the incremental cash flow of the project, the following guidelines must be borne in mind, because we have to consider all the incidental effect. That is, in addition to the direct cash flow of the project, all the incidental effect on the rest of the firm must be considered. The project may enhance the profitability of some of the existing activities of the firm because it has a complementary relationship with them, or it may detract from the profitability of some of the existing activities of the firm because it has a competitive relationship with them. All these effects must be taken into account. Therefore, in incidental effect, all the incidental effect that arising out of this project should be included in order to get an incremental cash flow. Then next we have to ignore the sunk cost. A sunk cost refers to an outlay already incurred in the past or already committed irrevocably. So it is not affected by the acceptance or rejection of the project under consideration. Therefore, we should ignore the sunk cost because it's an historical cost, no relation with the direct operational activities of the project. Therefore, such costs should be ignored. Then next we have to include the opportunity cost, because if a project uses resources already available with the firm, then it is from the side of the firm, it's a potential resources, it has an opportunity cost. Therefore, such opportunity cost should be included. Then next the question related to whether to allocate overhead cost or not, that the cost which are only indirectly related to the product or service are referred to as overhead cost, especially expenses like administrative expenses, managerial salaries, legal expenses, rent, etc., all called as overhead cost. Then for the purpose of investment analysis of the project, what matter is the incremental overhead cost because of this project. That should be added just like any other incremental cost attributable to the project, and do not add all the overhead cost that is already allocated to the firm. That means we have to add only those overhead costs that is arising out of the project, that is the incremental overhead cost should be added. Then finally, the estimating the working capital regularly. Apart from the fixed asset, the project requires working capital. Therefore, such working capital should be also estimated properly and added in order to get the incremental cash flow. Then next we have to move on to the next principle, that the principle of long-term funds. A project may be evaluated from various point of view: total point of view, long-term funds point of view, and equity point of view. Therefore, the measurement of cash flows as well as the determination of discount rate for evaluating the cash flows depends on the point of view adopted. It is generally recommended that the project may be evaluated from the point of view of long-term funds, that is, the funds provided by equity stockholders, preference stockholders, debenture holders, and term lending institution, etc. Because the principal focus of such evaluation is normally on the profitability of long-term funds. The sacrifice made by the suppliers of long-term funds is equal to the outlays on fixed asset and net working capital. The benefit accruing to the suppliers of the long-term funds consists of operational cash inflows after tax and salvage value of fixed asset and net working capital. Next, we can move on to the another principle, that is the principle of post-tax. That is, tax payments like any other payment must be properly deducted in deriving the cash flows. Put differently, cash flows must be defined in post-tax terms. It may be noted that the cost of capital employed for evaluating the cash flow stream is also measured in post-tax terms. Then the last principle is consistency principle. That is, the cash flow and discount rate applied to the cash flows must be consistent with respect to all the investors, that is equity shareholders and lenders, and it is also consistent with the current inflation rate also. Generally, we apply weighted average cost of capital of the firm. In dealing with inflation, we can incorporate expected inflation in the estimates of future cash flow and apply a normal discount rate, or alternately we can apply a real discount rate in the estimation of future cash inflows in real terms. Let us move on to the calculation of cash flow estimation based on its components. There are three different components in a cash flow stream. They are an initial investment, operating cash inflows, and a terminal cash flow. An initial investment represents the relevant cash outflow when the project is set up. Therefore, all these three cash flows represent in three different periods. The first one in the beginning, and the second in the initial, and at the end of the termination of the project, we will incur a terminal cash flow. The initial investment represents the relevant cash outflow when the project is set up. The operating cash inflows are the cash inflows that arising from the operation of the project during its economic life. The terminal cash flow is relevant cash flow occurring at the end of the project life on account of liquidation of the project. Let us measure all these cash flows in detail for a new and a replacement project. The initial investment, that is the manner in which the initial investment is defined, depends on whether the project is a new project or a replacement project. For a new project, the initial investment is calculated by adding the cost of capital on asset, then installation cost, working capital margin, and preliminary and pre-operative expenses. But in the case of a replacement project, the cost of the replacement capital should be added along with the installation cost, but post-tax proceeds from the sale of the old capital asset should be deducted. Change in working capital margin should be added. Tax shield, if any, on the capital asset should be deducted. Preliminary and pre-operative expenses should be added to the replacement project. Tax shield, if any, on replacement capital asset, etc. all should be deducted. Therefore, here the tax shield is the benefit due to saving in tax. Therefore, the calculation of a cash flow for initial investment for a new project and a replacement project is entirely different. Then let us move on to the calculation of the operational cash inflows. For deriving the operational cash inflows, the project profitability statement are the starting point. Since there is a difference between the recognition of revenue and expenses in accruing and the incidence of cash flow, the rigorous analysis requires that each item of revenue and expense be examined to find out the cash flows associated with. For a new project, it should be the profit after tax plus depreciation plus other non-cash charges plus interest on long-term debt into 1 minus tax rate. In the case of a replacement project, it should be change in profit after tax plus change in depreciation plus change in other non-cash charges plus change in the interest on long-term debt into 1 minus tax rate. Now we can calculate the terminal cash flow. The cash flow resulting from the termination or liquidation of a project at the end of its economic life is called its terminal cash flow. And for the calculation of the terminal cash flow for a new project, we will add the post-tax proceed from the sale of old capital asset plus net recovery of working capital margin. And in the case of a replacement project, the the post-tax proceed from the sale of replacement capital is added to the post-tax proceed from the sale of present capital asset plus net recovery of working capital. And let us move on to the various errors that arising out of the cash flow estimation. And the one of the core issue arising at the time of cash flow analysis or estimation is regarding the time horizon for analysis of cash flow. That is, what should be the time horizon for cash flow analysis? The time horizon for cash flow analysis, the minimum of the following, that the life of the project should be the minimum of the following aspect. That the first one is the physical life of the plan, that should be also taken into consideration. This refers to the period during which the plan remains in a physically usable condition. That we can say that the plan is fit to incorporate the present product activities. That is, the plan remains in a physically usable condition, that is the number of years the plan would perform the functions for which it had been acquired. And the second aspect is the technological life of the plan. The technological life of the plan refers to the period of time for which the present value would not be rendered obsolete by the new plan. That for the technology should be also fit in order to pace with the new developments that is expected to occur in the future. Then the third one is the product market life of the plan. That is, the product market life of the plan refers to the period for which the product of the plan enjoys a reasonably satisfactory market. That market should be also favorable for the project. That is, till that period we can say that the product has a market life. And the last one is the investment planning horizon of the firm. This is referred to as the investment it is the time period for which a firm wishes to look ahead for purpose of investment analysis, may be referred to as the investment planning horizon. For a small investment, for example, for a small investment of the investment planning horizon should be somewhat equal to 5 years, and for medium size investment it may be 10 years, or for large size investment it may be for 15 years. And for some infrastructure project like construction of building, hospital, etc., like it may goes up to 30 years is the investment planning horizon. And there is a scope for errors in cash flow estimation. That should be also we should remind in our mind before calculating the estimation of cash flows. As cash flows has to be forecast far into the future, errors in estimations are bound to occur. Yet, given the critical importance of cash flow forecast in future evaluation, adequate care should be taken to guard against certain bias which may lead to overstatement or understatement of true project profitability. Therefore, there is a chance for either estimating at a lower level or estimating at a higher level. That is, underestimation and overestimation may be there in project cash flow estimation. Therefore, first we can move on to what are the factors that leads to overstatement of profitability. The principal reason for such optimistic bias, that is setting a profitable level much above than the actual or the expected, that is leads to overstatement of profitability. The important reason for them are, first one, there is an intentional overstatement either by organizational pressure or through individual motives. Some people, they will always tend to overstate the profitability of their firm. Then the second one is native optimism. That is, people tend to exaggerate their own talents, and they believe that they are above the average in being endowed with some positive traits and abilities. Such people makes an over statement of profitability. And the third one is attribution error. That is just like native over optimism get amplified by the tendency to colleges. Typically, this means that people take credit for positive outcome and attribute negative outcome to external factors. Therefore, irrespective what is the true cause is, further the people tend to exaggerate the degree of control over them, downplaying the role of luck. That attribution error may be also a result, may be resulted in the overstating the profitability out of a project. And the fourth one is anchoring. That means certain people are very rigid, and they make any no change in their attitude, behavior, like that. That is called anchoring. After forming an opinion, people are often unwilling to change it, even though they receive a new information that is relevant. This is due to anchoring, a very strong cognitive bias. Then due to this aspect also, some people always stick on to their own high stated profitability state of the firm, or maybe the project. Then the next one is a lack of experience. That is, sometimes the people who are conducting that accounting activity may be a new employee, or a person with a very short or a very limited experience, may leads to some kind of overstatement of profitability. The next one is myopic euphoria. That is a situation individual responsible for preparing forecast may become too involved and lose the sense of proportion. The lack of objectivity in this case is neither intentional nor due to inexperience. It's a kind of mental condition, that is people in a particular mental state, and they think very optimistic, and they makes that they create an overstatement in the cash flow estimation of the project. Then next one is competitors neglect. That is, in developing forecast, executives generally focus on their own ability and plan, neglecting the ability and potential action of competitors. They undermine the competitors in this field. Therefore, they boosting their own figure instead of considering the strict competition that may arise in the market. Therefore, they will create a positively highly stated profitability. Then next one is stretch targets. In top management, in most of the organization, they believe in setting a stretch targets for various business units. While this can be have a statutory effect on motivation, it can skew the forecast of unit managers toward unrealistically optimistic outcome. Furthermore, organization actively discourage pessimism. It may this stretch targets also may lead to overstatement of profitability. And the last one is organizational pressure. In every company, the money and the time available for new project is very limited, and awareness of this constraint induces project sponsors to exaggerate the benefit of projects proposed by them. And next we can move on to the another important error, that is the understatement of profitability. The problem of optimistic bias may lead to an overstatement of project cash flows and profitability. There can be an opposite kind of bias relating to the terminal benefit, which may depress the project's true profitability. And the reason for understatement of profitability are the salvage values are underestimated. For example, net salvage value of fixed asset may be equal to, or we can say that in real life situation, the net salvage value has a very commendable substantial market value to the project, but this salvage value are underestimated, and even sometimes they are being ignored in the calculation of profitability. That may be due to the maybe due to some reason, like the rate of physical wear and tear is usually much less than the rate of depreciation of tax or accounting purpose, or maybe due to the secular rate of inflation in India have been around 6% or something like that, and we always underestimate the salvage value. That is a very good benefit, that maybe a good commendable mm, value, substantial market value, but we are ignoring the salvage value, maybe leads to an understatement of profitability. And the second important reason for understatement of profitability is that there are so many intangible benefits that are expected to arise in a project that are maybe ignored. Intangible benefits that are not visible, not measurable in real terms. Such benefits are ignored. For example, apart from investment in tangible asset, intangible assets like the company get a good market position, then next expansion in research, engineering capability, and developing a distributional network, and building a brand loyalty. All these benefits should not be ignored, because just many a time people will ignore such intangible benefit because it is very difficult to quantify them. Many of them are qualitative aspect, therefore such benefits are ignored, but for the real estimation, such intangible benefits should be also included, because we have to quantify it and finally add its market value to the calculation of the projected cash flow statement. And the last one is the value of future option is overlooked. In many of funds, firms will overlook an expected option in future, and we will underestimate the current operation. For example, let us take an example of a firm that wants to be a market leader in the field of two wheelers. At present they are only selling scooter, and in future they want to become a market leader in the field of all the types of two wheelers. However, the firm considers that in the entry into the motorcycle market to be infeasible currently, as it lacks technical expertise or market image to challenge well entrenched manufacturers in this field. Thus, the proposal to manufacture motorcycle hinges on the expertise developed and success achieved in the field of scooter. Therefore, they overlook the future option, and they undermine or underestimate the current operation of the firm related to a particular product. And these are the aspects that we have to bear in mind for before calculating the project cash flows.